Today, we're looking closely at how mortgage lenders actually vet applicants. This is sort of the ultimate financial shortcut understanding the process lenders use to analyze risk, verify your status, and, well, spot anything that looks even slightly off.
That's right. Our mission in this deep dive is to move past all the glossy brochures and get into the really complex, multi-layered process that lenders use. We're going to verify that an application is not only genuinely affordable, but also, completely free of fraud or money laundering risk. We're diving into credit scoring, the hidden dangers in your bank statements, and the high-stakes legal world of guarantors.
Okay, let's unpack this then. This feels like essential knowledge for anyone entering the world of high-stakes borrowing. We're drilling down into how lenders move beyond just a simple paycheck verification to really dig into credit searches, the cold statistical reality of credit scoring, and the strict demands of financial crime compliance. So when you apply for a mortgage, the lender starts with standard due diligence, checking references and critically reviewing your bank statements. What exactly are they scrutinizing beyond, the simple balance?
Well, they look for several key indicators to establish stability. They verify that your regular income actually matches what you claimed. They check for consistency in regular payments out, like rent, utilities. They also look very closely at financial stress markers.
Stress markers.
Yeah, things like the frequency and reasons for using an overdraft, the accumulation of fees, especially those unauthorized overdraft fees, and any instances of return checks or failed direct debits. Those are immediate signs that income and expenditure are not comfortably aligned.
What's fascinating here is that while those visible transactions give a pretty good picture, the truly damaging risk often hides in the information that's not revealed by standard references and statements. This is where the lender needs to become, what, a financial detective.
Precisely. We've identified four crucial blind spots, things that are legally binding liabilities or stress indicators that just won't appear on a standard bank or credit statement, but they're absolutely vital for an affordability assessment.
Okay, give us the specifics on those four hidden dangers.
First, purely cash transactions. These can conceal undeclared income or, more commonly, borrowings from family or friends that the applicant just hasn't included in their stated liabilities.
Right.
Second, action for maintenance or child support claims, a potentially significant ongoing financial drain that isn't typically part of your monthly utility checks. Third, any pending court hearings against the applicant that could result in large financial judgments. But the most dangerous blind spot for a lender assessing risk is the fourth one: agreed upon borrowings that are yet to be drawn down.
Wait, hold on. If the money hasn't moved, how is a lender, outside of just asking the applicant directly, how are they possibly supposed to verify that a liability exists? That sounds like a massive affordability gap.
It is a massive risk. Imagine an applicant has been approved for a £50,000 personal loan or a new credit card, but hasn't activated or accessed the funds yet. That liability won't be visible on their current bank statement or even necessarily flagged on a standard credit search instantly. But the second they draw it down after the mortgage is approved, their debt-to-income ratio just collapses.
So what can they do?
The lender has to ask very specific questions and look for supporting evidence of any such agreements, often cross-referencing against multiple credit bureau searches.
So to combat those blind spots and verify core facts, credit searches become mandatory. And these searches are clearly not just about debt history, are they?
No, not at all. They serve dual functions. First, they're vital for residency verification. Lenders use services like the electoral roll to confirm the applicant is permanently resident at the address they provided. It's a basic anti-fraud step. Second, they are the primary tool for tracking historical risk via the credit reference agencies, Experian, Equifax, and TransUnion. They provide a documented history of financial behavior. And that documented history is where the lender looks for the really serious flags, like a default.
We hear that term a lot, but what exactly constitutes a default in the eyes of a lender?
A default occurs when a borrower misses one or more payments and then fails to satisfactorily respond to the lender to correct that problem. This is when the lender essentially gives up on recovery through normal means and formalizes the non-payment. And that leads to serious long-term consequences for the borrower.
How long do those consequences actually shadow an applicant? I know the general time frame is 6 years, but how does that play out in practice?
The record of the default shows for 6 years from the date the default notice was issued. And this is crucial. It shows for 6 years, even if the borrower clears the arrears shortly thereafter. The record details the original defaulted amount and all the subsequent payments. So if a lender sees a recent default, they will almost certainly decline the application. Or, if the issue was resolved successfully a long time ago, they might be more sympathetic, but still impose a higher interest rate to cover the perceived risk.
That retention period is lengthy. Now, let's spotlight a specific financial product that raises a huge red flag: payday loans. These are short-term, high-interest, unsecured loans, and they're viewed by most major lenders as last resort borrowing.
It's a massive red flag because taking out a payday loan signals a fundamental failure in budgeting or, a chronic structural income shortfall. It suggests the applicant couldn't secure funds through any standard means.
And there's a technical difficulty lenders face with them too, right?
Yes. Because of their extremely short duration, often less than a month, payday loans may not even appear on all credit searches if they were taken out and repaid quickly. Lenders have to conduct exceptionally thorough due diligence, often using multiple specific data searches to check for any taken out within the previous 6 years. They just cannot rely on a single standard search to reveal this kind of high-risk behavior.
Right. It forces them to dig deeper.
Exactly.
That high-risk behavior assessment really brings us to the statistical heart of vetting: credit scoring. For many of us, it truly feels like a black box that just spits out a magical number.
It's anything but magic. Credit scoring is purely a statistical tool based on extensive historical data. Its sole purpose is to estimate the probability that a particular applicant with their specific set of characteristics will repay satisfactorily.
So it's not a prediction.
No, it's explicitly not a prediction of what will happen in an individual case, but a measure of aggregate risk.
What are the primary inputs that go into that statistical model when a lender is calculating their cutoff score?
Lenders consider a wide range of quantifiable factors: the applicant's age, income stability, occupation, existing financial commitments, the number and recency of previous credit searches they've undertaken, and critically, the conduct of any existing bank accounts they hold with that lender. Every single factor is weighted.
And since we know no two financial institutions have the same tolerance for risk, I assume there's no single universal scoring model.
Absolutely correct. No single model exists. Lenders tailor their models to reflect their own specific risk appetite. You'll find lenders willing to accept a higher statistical risk profile, but they offset that by charging higher interest rates.
And on the other end,
Conversely, others screen rigidly for only the most creditworthy borrowers, allowing them to offer the lowest rates. It's also vital to note that these complex systems often include override features, allowing a human supervisor discretion on borderline applications that might otherwise be automatically declined.
here's where it gets really interesting. We need to discuss a major risk mitigation strategy, especially for applicants who need a higher mortgage or lack a long credit history: the use of a guarantor. This is where another individual accepts legal responsibility for the loan repayment.
The guarantor is the lender's critical fallback.
Yeah.
They step in when the borrower's own profile isn't strong enough. The first crucial distinction for you to understand is the type of liability the guarantor assumes, because the exposure can be wildly different.
Let's lay out the financial exposure for both types of guarantees.
Okay, first we have full liability. This means the guarantor is legally liable for the entire debt if the borrower defaults on the mortgage payment.
The whole thing.
The whole thing. To be approved for this, the guarantor must prove they have the financial capacity to afford 100% of the mortgage payment, in addition to meeting all of their own existing financial commitments. Their finances are fully exposed.
That is a life-changing amount of exposure. What about the alternative, limited liability?
In limited liability, the guarantor's exposure is restricted. It's typically limited to the difference, the shortfall, between the maximum loan amount the lender would normally lend to the borrower on their own and the total amount the borrower actually needs.
Can you walk us through a quick, simplified example to clarify that difference?
Certainly. Let's say the borrower needs a £200,000 mortgage, but based on their income and credit history, the lender would only offer them $150,000. The shortfall is £50,000.
Right.
In a limited liability scenario, the guarantee might only cover that $50,000, perhaps with an additional 10% on top for fees and interest. So the guarantor is liable for maybe £55,000, not the full $200,000.
That dramatically changes the risk calculation for the person offering the guarantee.
It really does.
Whether it's full or limited, a guarantee is a formal legal contract, and I recall some major legal pitfalls. What issues can actually render a guarantee invalid?
Lenders have to meticulously guard against several legal issues. We're looking at lack of capacity. If the guarantor is a minor or has a recognized mental illness, or duress, meaning they were forced to sign through physical threats. But the two most frequent grounds for invalidating a guarantee are misrepresentation and undue influence.
Undue influence is often cited in family situations, right, where one party has a position of dominance.
Exactly. Undue influence occurs when one party dominates the other and persuades them to enter into an agreement they would not have otherwise chosen. It's common in spousal relationships, parent-child dynamics, or even professional relationships like doctor-patient. Because this area is so contentious, it has been heavily shaped by legal precedents that force lenders to act cautiously.
Which case completely changed how lenders must advise prospective guarantors.
That would be the landmark case of Barclays Bank PLC v. O'Brien from 1994. In that situation, the wife's guarantee was invalidated because she was subject to misrepresentation and undue influence from her husband, and crucially, she had not sought independent legal advice.
So the court decided the bank had a duty of care there.
It essentially ruled that the bank had a duty to ensure she understood the gravity of what she was signing.
So the key takeaway there is that lenders now must advise prospective guarantors to seek independent legal advice.
Precisely. It's now an established feature of responsible lending. And then there's the issue of clear communication, highlighted by Lloyd's Bank v. Waterhouse in 1991. Here, an illiterate guarantor was incorrectly told he was signing a limited guarantee when it was actually a full liability agreement.
And the court.
The court rejected the bank's attempt to enforce the full debt because the bank had misrepresented the terms. Lenders cannot afford to be negligent in their explanation of the agreement's nature and effect.
Once mitigation strategies like guarantors are maxed out, what happens when an applicant comes in with existing serious financial baggage? That's when lenders have to look at formal remediation processes. Let's start with county court judgments, or CCJs.
CCJs are civil court orders, dictating how a specific debt must be repaid. They are a massive black mark, but here's the detail. They stay on the register for 6 years from the date of judgment.
But there's a small window for reprieve if the debt is settled quickly.
Yes. The crucial exception is if the judgment is paid in full within 1 month of the judgment date. If that happens, the CCJ is marked as satisfied and removed from the public register entirely.
And if you miss that 1-month window?
If they pay it off after that, the CCJ remains on the register for the full 6 years. And lenders view concealing a known CCJ on an application very dimly. It's not just bad form.
Right. Knowingly concealing a CCJ from a prospective lender is actually a criminal offense. Beyond CCJs, we have the most severe options: formal UK insolvency processes. These need clear differentiation, as lenders treat them very differently.
We can differentiate between 3 types based on severity and the amount of control the debtor retains. Think of them as a sliding scale of financial distress.
Start with the least severe, the debt relief orders.
Debt relief orders, DROs, are for individuals with low assets and low disposable income, specifically a max of £50,000 in debt, max assets of $2,000, and disposable income not exceeding £75 per month. The upside for the debtor is a 12-month moratorium where creditors cannot pursue the debt. The downside for a future lender is that this indicates a profound inability to manage even small finances.
Okay, next up the scale.
Next up are individual voluntary arrangements, IVAs. This is a negotiated solution. The debtor needs 75% of creditors by debt value to agree to a reduced payment plan. If agreed, interest and charges are frozen, and the debtor makes fixed payments, often over 5 or 6 years. This is a controlled recovery, but still a serious red flag.
And finally, the most severe, bankruptcy.
Bankruptcy is the formal process where the debtor's assets transfer to an appointed trustee to be liquidated to pay debts. This gets particularly complex with jointly owned properties. If the bankrupt individual's share of the property's equity exceeds a relatively low threshold, £1,000, the trustee can apply to force a sale.
That sounds devastating, especially for a family home.
It is, but there is some protection. If the property is the bankrupt's main residence, the forced sale may be delayed for up to 12 months to allow for family arrangements. However, the trustee has 3 years from the date of the bankruptcy order to decide whether or not to ultimately proceed with the sale of the main residence.
That deep dive into debt brings us directly to the dark side of lending. Mortgage fraud, obtaining funds by dishonest means. This is a massive concern for the entire financial sector.
It is, and the scale can range from a desperate individual overstating their salary to highly organized criminal gangs. Common examples of fraud include submitting false salary references, knowingly omitting existing debts or outgoings, procuring bogus property valuations, or in organized crime, attempts to finance properties that literally do not exist.
The legal consequences for this aren't just civil. They are seriously criminal, regardless of whether the mortgage funds are actually granted.
Absolutely. Lying on an application or failing to disclose relevant information is a crime under the Fraud Act 2006. Moreover, if any value is successfully obtained through that fraud, those funds are automatically regarded as proceeds of crime under the Proceeds of Crime Act 2002. This means the borrower has committed a serious money laundering offense, dramatically escalating the penalty.
Which brings us neatly to our final segment, anti-money laundering, or AML, regulations. These aren't just about vetting the borrower, they're about vetting the source of the funds used in the transaction.
Due diligence is mandatory. Lenders must take steps to obtain evidence of a client's identity and, crucially, evidence of the source of funds, that is, where the deposit money is actually coming from. This is to ensure the transaction is legitimate and not part of a criminal enterprise.
So what qualifies as acceptable evidence of identity? Because it can feel like a massive bureaucratic hurdle when you're trying to move house.
It's rigorous for a reason. You must provide a government-issued photo ID, a valid passport or driving license, plus a second document that confirms residency, like a council tax bill, a recent bank statement, or confirmation from the electoral roll.
And a quick, important note on exclusions.
Yes, mobile phone bills simply don't cut it when it comes to AML verification. They are not acceptable forms of ID because they aren't deemed sufficiently robust proof of residency or identity. All this documentation, by the way, must be retained by the lender for at least 5 years after the relationship with the customer has ended.
And finally, the role of staff vigilance in preventing financial crime.
Staff must be constantly alert to unusual transactions that don't fit the expected pattern of the customer's profile or history. If a low-income applicant suddenly produces a massive, unexplained deposit, that needs investigation. However, staff are only required to report when they have a genuine concern. Not every unexpected transaction is evidence of crime. There may be a perfectly reasonable explanation due to a customer's changing circumstances. The key is applying due diligence and critical thinking.
This has been a fascinating deep dive. We've covered everything from what a bank statement hides, through the mechanics of credit scoring, the complex legal risks a guarantor undertakes, right into the severe legal ramifications of fraud and AML compliance. The core lesson here seems to be that being truly well-informed about an applicant's credit status requires checking for those hidden debts, understanding the full legal weight of guarantees, and adhering to strict rules designed to combat financial crime at every single level.
Exactly. Risk assessment in lending is an informed, statistical probability game. It requires critical and skeptical due diligence at every stage because a lender's biggest risk is always the information they don't see.
So what does this all mean for you, the individual? Considering the extensive financial data lenders use, including that 6-year retention period for a formal default that might have been paid off years ago, what level of historical financial transparency do you believe is appropriate for institutions making these critical lending decisions? And how does that necessary transparency truly balance with your individual privacy under modern data protection legislation?